Welcome to the final instalment of our three-part video series. My name's Vince Green. I'm a partner with Crow in the Recovery Solutions team and also a licensed insolvency practitioner. I'm here with my fellow partner, Stephen Edwards. Stephen is also a partner at Crow and also a licensed insolvency practitioner. This is the final part of our three-part series, and we talk about work that we do to wind down the company that's suffering from financial difficulties. We also discuss the process of liquidating a company that is solvent and has reserves to be distributed to its shareholders. In part one, we discussed the work that we do to rescue a business that's suffering from financial difficulties, avoiding the formal insolvency procedures. In the second part, we discussed the formal insolvency procedures as well. So in Recovery Solutions and as insolvency practitioners, we help businesses with restructuring, recovery and insolvency. There are two types of voluntary liquidations. One is for an insolvent company and the other is for a solvent company. An insolvent company may use a creditor's voluntary liquidation procedure, commonly known as CVL. A solvent company can use a member's voluntary liquidation, commonly known as MVL. A CVL is the most widely used of all insolvency processes. It's used to wind up a company's business when it's no longer viable. It's insolvent and its business has little or no value on the open market. So Stephen, when you meet with directors, do you discuss an insolvent company? What do you initially discuss with the director?
First of all, what I find is you're in a meeting and the directors think there is one option available to them, and that is liquidation, more commonly than not. There's different options that are available and it depends on what the circumstances of that business. And the starting point is always, are we able to rescue that business? If we're not and there is no viable business to sell, then we're looking at the liquidation. A liquidation is essentially a close down of that business, and we're instructed then to realise assets and deal with its affairs and to wind that down. If liquidation is the most appropriate route, then that conversation has to be had with the directors, and that can very often be, they can be very difficult to have at times, and again because there's a feeling of responsibility for that business by the directors, and the business is being closed down. So we have to think about and discuss with the directors why and how we deal with customer orders that aren't going to be completed, how we're going to deal with creditors that aren't going to be repaid. And the most difficult discussion is often around employees and the necessity to make people redundant from their roles and to bring their employment contracts to an end. And those can be very tough discussions. I find sometimes directors want to be involved with those discussions with their team, and sometimes they don't, and that's a decision for them. But it's always a difficult discussion to be having. What I do find, however, is that by providing information to the directors on the process that needs to be followed in relation to the liquidation generally, and then also in relation to the claim process for creditors and also for employees, that helps because the government will, through the redundancy payment service, process claims of employees up to a certain amount, but that does guarantee that employees will be paid a sum in respect of their outstanding claim, even if the company doesn't have any monies to do it. So the government will pay those monies out in the first instance. That covers arrears of pay, holiday pay, notice pay, and also redundancy pay. So that allows a certain amount of comfort.
So when you meet with directors, or we meet with directors, what are the other issues that directors are particularly concerned with?
There are many. It's always a difficult conversation again, because it depends, I suppose, on how that business is structured and how its finances were structured. Because one of the most common conversations that I have with the director that's going through a liquidation process is that in relation to personal guarantees. So a director may have opened the door for claim through a business expense against them personally, through signing a personal guarantee. And the liquidation, of course, triggers a point where where the director has historically drawn income from that business that's been able to pay them, but that source of income has then ceased, and they can't then pay the personal guarantee. So it leaves the director at quite an uncertain position going forward. There's also times when the director has loaned money to that business to see it through, and the director, of course, is a creditor of that business, and what they always thought as an asset then becomes one that's not going to be recoverable by them. Those are two of the main areas that I have discussions that are difficult. So, Vince, when we're appointed as liquidators, we've talked about the asset position. What are your duties as liquidator, and what process do you go through to clear those assets?
When we're appointed liquidators, of course, we take control of the company, and the directors' executive powers of management cease. So we're responsible for realising the company's assets, converting them into cash to enable distributions to be made to the creditors. We're also required to undertake an investigation into the affairs of the company and the conduct of its directors. The investigations really are there for the purpose of identifying further assets that may not have been disclosed to us, and hopefully enhancing the value generally. We also have a duty to prepare confidential reports, of course, to the disqualification unit, and that's based on the conduct of directors or directors over the last 3 years. If we then, on the other parts of the investigation, we find perhaps dividends have been paid to the shareholders at a time when there's insufficient reserves, then we'll speak to the directors, shareholders, and try and recover those monies for the benefit of the creditors. We also look at the question of preference, where perhaps one creditor or a group of creditors have been preferred to a general body of creditors. And if it is a preference, then we'll try and recover those monies again, so that all creditors are seen to be dealt with fairly. Essentially, it's about fair play, and that's what we're trying to protect. And occasionally we come across situations that just doesn't happen, of course. So in terms of investigations, they can be quite complex, they can be quite straightforward.
Yeah, indeed. And are all liquidations subject to investigation?
No, they're not. The only investigations that we carry out are for insolvent companies, and they may be a company that's in liquidation or, of course, administration. The reason for that, of course, that in solvent liquidation, all creditors are paid in full. That's basically the type of investigation that we undertake.
Okay, so what is the purpose then of a solvent liquidation?
So a members' voluntary liquidation for a solvent company is generally used where a company has reached the end of its useful life. It can be used as part of a group structure to simplify that group structure, or purely for tax reasons. And where we're appointed, we look at tax efficiencies as well in making that return to the shareholders. And the shareholders is actually described as a capital distribution rather than an income distribution, so it's tax efficient in members' voluntary liquidation. We also, as part of the process, to do a belt and braces job, of course, is to get agreement from HMRC for tax clearance for the pre and post liquidation period. So when companies eventually dissolve, once we've dealt with all the distributions, it's clean, it dissolved, it will it's unlikely to be restored to farm.
I agree. I think what we've done here is we've clearly illustrated over the course of our 3-part series that we add significant value to the life cycle of a business when we're needed. Whilst parts of our job have an element of doom and gloom, the contribution that we make to businesses can be substantial, and that can mean that a business can survive and prosper into the future. The satisfaction from our role comes from working with people, understanding their concerns, and doing the best job that we can for them. We hope that this video series has been informative and provides an insight into the work we as insolvency practitioners do. And that being to add value and to provide an outcome to companies that are in financial difficulty, to find a way out of their problems. We thank you for listening. And if you have any questions or queries, then please contact Vince or myself or your normal Crow contact. We'd be pleased to help. Thank you.